And welcome back to NinjaTrader Live. I'm your host, Tom Schneider, CMT with NinjaTrader, and it's my pleasure to host Traders Workshop, where we bring on our NinjaTrader ecosystem partners so that you can learn about trading, the markets, all the good stuff from them. And today is no different. We have a repeat guest, frequent guest of the show. My pleasure to bring on Mike Arnold, Path Trading Futures. How you doing, Mike?
Doing great. How are you doing today?
Doing great. We have and I know we're in different parts of the country. We finally got a little bit of a downturn in temperature, but sunny skies here, so can't do much better than that.
Yeah, it cooled off here finally. I mean, it went from incredibly hot to then below, especially in the mornings, below normal. This morning was 41 degrees,
Oh my
you know,
gosh.
at 4 a.m. But it's a nice relief. We're having highs 68 to 72, so you can't complain there.
Yeah, that's like perfect room temperature, but it's outside. I love it. I love where you live. I'm not gonna, say anything different. It's my favorite place in the United States to be is where you are. So a little jealous there. Um, But we just had your podcasting partner, Bobby Iacchino, on. I listened to your latest release. You do a monthly show with Bobby and Jimmy. So just, maybe we can take a look and kind of talk about those items that you were talking with them about of what you see in the markets going into the end of the year and into next year.
Sure, that would be great. I wanted to tie in because I was on here, making sure everything was working with the setup, and so I did get to hear Bob filling in a emergency pitcher change for Jim. Uh,
Yeah. Last minute change, and we talked about CPI being a nothing burger, not a nothing burger for Jimmy Iorio. He was busy with a kind of unexpected work around that number. So nice to have a rotation. Nice to have a bullpen.
it is always nice, and you guys were talking about the dollar index and using the euro as a proxy. Can we just
Yeah.
start there?
Sure. Yeah.
Because
Let's do it.
we're at a fascinating level, a absolute fascinating. So here's the weekly DEES futures chart, and we have we have a very interesting thing. We sold off again. I would not be anything looking to buy this thing. I'm looking for any bounces for rollover plays because we just broke a major support area. We closed just above it last week. This week it's been obliterated. I mean, we're still only midweek, but we're probably, unless something shocking happens, we're going to close below it. So now all the prior support levels, which held uh, in 23 and so far in 24 have been broken on a harmonic front. If we take the harmonics from the low in 22
Hmm.
to the high in July of 23, and we do the harmonics. I always talk about that 62 and a half level. If you follow right there, that's around this 105.60 area, 105.70. We're trading right there.
Right there.
If we shift, and it doesn't have to be this week, but start closing below 105.60, we've then shifted the probabilities where we could retest the lows from 22, September, October lows from 22. So that could take us back to the 101 area, potentially in the euro, and the dollar, being euros making up over 50% of that, of the dollar index, could continue to drive it definitely higher. So that's where I am really focused to see if we do close below that 105.60 area this week, or if we follow through the next couple weeks going there. It then we have not only the key support broken, but we also shift probabilities to lower for longer in the euro and potentially sell, watching for shorter term sell setups on any bounces in that.
Yeah, that's really interesting. Going back that far back, we have to because we're so close. Uh, you know, Closer than we've been in a while, right? Since almost 3 years ago, to parity, right? And it happened. It happened in what September 2023. or thereabouts, maybe. Yeah, end of September. I had a little bit of a projection based on the daily chart using a two-headed head and shoulders to project to like 103, and I thought that was kind of egregious. That's too much. But I didn't look back to your time range, which is a 3 year. It looks like you're looking back on this chart about 3 years to those lows, and this makes that's a very good case because I think when I think of that 62.5 level, I think of that kind of as almost a water line or a breaking line for if it reflects, then we'll probably continue on a trend upward. If it breaks through, then we'll probably hit that 100% level a little bit more assuredly. It's not like, oh, we'll just hit the 2075 in reverse or the 87 in reverse. To me, it's like, okay, we're in for a pound, we're in, or in for a penny, in for a pound kind of thing.
Yeah, and all the testing I've done, my rule of thumb is when you get these longer term closes beyond the 62.5, and this is a very key line in the sand. Could it hold here? Could we and not break and we hold here for a series of maybe weeks and form a bottoming pattern and then bounce? Yeah, it could. But the 62.5 is a very key area because the magnet price then technically becomes the 87.5. Can it
Okay.
continue down and hit full parity again? Sure. But my target for structuring trades would be that about that 101 area for setting up any rollover trades. Once we do officially break that 87.5 or the 62.5. Also, if you notice, back in July of 22, we bounced, we spiked below it, but we did not close below that 105.60 level. Little rally up into the rotation zone on the weekly basis, rotated down, broke that level with the key close below it, and then that became exact. It pretty much closed there on the week of September 16th back in 22, and then proceeded lower. So not only just from a harmonic standpoint, but just pure price action. And the closes are much more important than the highs or lows. Highs or lows give you an area. Closes tells you, okay, especially on a weekly close, we traded all week and we could not regain or we solidified below a key level. That is very significant. So that's why I'm watching either this week or next week to see if we can really get below that 105.60.
And that's a good point you make about price action because when we look at those levels, it's based on that one trend, right? It's the lows from September of 2022 to the highs in looks like July of last year. So the market really wasn't informed of that trend right before that. It just so happens that, hey, this is where the market found support and resistance before we knew about these levels. And it's kind of like a confluence of different techniques, right? One is based on your harmonics, and one is just price action happening.
Yeah, and that's why the it doesn't make it's not like it's makes it magically higher probabilities. You still have to take the probabilities of the harmonics separately from pure price action. But
Sure.
I call it clusters. When you get things cluster, that's why there's somewhat of a rhythm to the markets. And when you get things cluster, it can lead to very, very key, significant areas where the market can react. That's why we needed to really break where it's trading now before we can then target that 101 area. But once we do break it, we then shift those probabilities majorly. And we had warning signs that this was happening because earlier back between the highs at the end of August and then the retest those highs at the end of September, we formed a really nice double top pattern. We then at the beginning of October closed below the base of it, triggering that, which then led the target to be 107. We've then closed below that, so it's a follow through trade, and then the next target was a 62.5. We break that 62.5, the target becomes the 101, so the 101 area. So that's how, again, it can be layered in. Now, any of these could have provided stopping points, but so far the trend is still down in the longer term.
I like that. I like that you bring up the double top because what I think people need to realize is a double top is a resistant pattern. a bearish pattern. Some people look at a double top as something that has to be broken through, right? We test a double top till it's broken through. Not the case. A lot of times it is you look at a breakdown from a double top, and then it has to break out of what we call neckline in the head and shoulders pattern. But it's more of a level that we see as support. When that's broken, then like you said, you have your targets lined up with harmonics.
Yeah, and you see here, I just put them on from before. And the final target was actually 108. Or I said 107 before. It was 108. And you see it came down there, spiked down there, and then yeah, we at least paused there for a week. And then the next week, hey, we went down a little 1 day pause, returned to the rolling over weekly rotation zone, and now we've just fallen out of bed. So, that's not to say we can't get these pausing weeks, we can get bouncing weeks. But again, when you get a 1 week pause, you see this little green week. We had a series of 4 straight weeks down, a 1 week pause. When you broke these two bottoms, that was a very bearish sign. It's one of the key things I watch for when you get either on daily and weekly charts, when you get a one candle opposite color and then you take out those lows with momentum and follow through on a close, it is a very strong continuation pattern that can be used with other key setups.
Now, Mike, you bring up the one bar, reversal, pause, whatever you want to call it. It doesn't fit in with the trend, right? You've got 4 consecutive red candles, then a green candle, then 2 big red candles. Uh, have you looked at Heiken Ashi just as a way to say, you know what, even though we've got this green candle here that's on this weekly chart, maybe there's a reversal happening. The Heiken Ashi would probably show a red candle there, because it's doing different calculations. Do you ever complement that just to say, you know what, I see this reversal happening. It's probably temporary. I'm trying to look. It looks like the high in that candle was higher than the previous week, so that's concerning, right? But do you ever look at something like a Heiken Ashi that kind of makes the trend easier to look at?
Yeah, I will look at those charts, and I've done a fair amount of testing with those charts. I generally don't flip back and forth because
Mm-hmm.
I already know the probabilities based off of one pausing bar and then a return to a key little resistance shelf. So I don't have to flip back and forth charts that many times. But
Sure.
that is, if somebody is looking and understands the Heiken Ashi charts, that can help them clarify, yes, that we still are in a substantial trend, and we're only on a time frame basis seeing a potential pause, not in a more of a trend basis.
Right. Not on a price level basis. Maybe we can switch over to the E-mini because we here at the live stream we're talking about 6,000 for so long. When will E-mini hit 6,000? Now now we're looking at it from a different vantage point. When will it return to 6,000, right? If it will. I'm just curious what your levels, your harmonic levels are, and what you're seeing for this key areas for the E-mini.
Okay, so far I know you were talking with Bobby about 5,900. 5,900 is a pretty major pullback level. If we do pull back there, it's very short-term key support. Again,
Okay.
you're coming into a lot of support down there. To the upside, the targets now, if we do break through this 60-50 area, the targets go to about 61.15, 61.60, and then 62.71 if we remain in absurd mode. I'm possibly, though, watching. The trend is still up. The trend is clearly still up. We're getting into that from just individual stocks levels, just hold your nose by everything, which I would not be doing from a short-term perspective. Trading the futures from a short-term perspective, as long as we do hold above this 5,900, at least on a closing basis, is perfectly good in the short term. In the more medium term, if things start rolling over, if we start getting weakness, holiday sales start getting weakness, I think we could put a end to the rally before year's end. But again, I don't have a tradable signal. So I am watching for a tradable short signal to come up. There is not one yet. But even with a potential shorter term short signal, your key level is now, just remember, 5,500. That would do some pretty short to medium term technical damage, but it would not do any longer term technical damage as long as we don't close below 5,500. We close below 5,500. We've lost the 62.5 from the lows in August up to the most recent highs, and we've lost the daily 200.
Right.
Besides that, that's your more key line in the sand to really start watching on a bigger pullback. The minor levels are those 5,900 levels to watch for. Beyond that, if we did break 5,900, the intermediate level between the 5,500 and 5,900 is about 57.30s on the D's contract.
So, Mike, that would also, going back to that 5,500 level, we would also be making a lower key, swing low. If you look at this uptrend, regardless of how big the pullback has been, we've had, I think, 8% pullbacks, 3% pullbacks. The consistent thing about this trend, which is what helps to define a trend, is higher swing highs, higher swing lows. And we haven't always gotten the higher swing highs, but we have been pretty consistent with a higher swing low. Maybe this recent one got back to the last, swing low hot dog pattern that you see there. But, if we get back to that 5,500 level, we're taking out the swing low from last week or the week before. And that to me would be another kind of crack in the armor of this bullish run.
Yep,
And then of course
that's why.
closing below 5,500, those two really key levels. The 200, it's not something we visit a lot, right? Because it's just a longer moving average. But when we do, it's something we have to really pay attention to.
Completely correct, and you were correct in everything you said, because that's why the intermediate levels around that 57.30 area, we start breaking that. You've broken the series of higher highs and higher lows. The next key areas come down to that 5,600 to 5,500, and if you break 5,500, then something in the more medium term has broken, and we could watch for potentially a bigger pullback. Now, some of these bigger pullbacks could be really good buying opportunities. I'd rather buy. I'd rather see some of these bigger pullbacks. It makes it a lot easier to buy a market, because right now the short-term reward to risk, it can continue in the short term, but we are taking potentially some of these bigger risk elements. We could easily within the next few months get a 20-30% pullback. So from my perspective, trying to eke out a few more percentage points in order to take a 20 to 30% downside risk, it is not very balanced. So short term, yeah, very short term, yeah, you got to stick with the trend. But if we start breaking some of these key levels, I'm going to be hands off and much more patient, waiting for buying opportunities.
Yeah, that's really interesting. And I agree with you. The pullback does give an opportunity to get long. What we run the risk of now is buying at the high. I mean, if you want to say, I want to participate, you're right. What is your upside target versus what are the real risks? And it seems like there's more downside than upside potential in the shorter term. That's a hard proposition sometimes. If you were long a week ago and before Tuesday's events and Thursday's event, man, you're feeling pretty good, right? But does that mean you start adding to your position now? I don't know.
For me personally, it's in trailing mode, and it's just ratcheting up
Hmm.
the stops as it goes higher. And then I know where the key levels are. Like in the short term, it's at 5,900. We start closing below it. Hey, if you manage to grab something right post election and you're riding it, all right, that's where it's maybe to take some more off the table if you haven't already taken some off in a trailing mode. Personally, that's why I like to do the harmonic projections higher, because I like to unwind things into strength, and then I leave some on for trailing, and I hope that I generally trail out of stuff because, hey, you're never going to capture the exact full move. I've taken some stuff off in the strength, and then I'm just letting the market take me out of the remainder of the position.
Yeah, that's one of my favorite things to do in terms of intraday trading, right? Same concept. And what I love about it is you get filled, you don't have to worry about leaving an order sitting in, that you forget about, which at my age, is becoming more of a concern, right?
Yep, exactly.
So we're looking at the 10-year now. This is
Yeah,
great.
the 10-year, the micro yield, love the 10-year micro yield. Keep an eye. I just want to touch base before we run out of time on this, because there's a real interesting line that's saying we sold off a little, which shocked me after the CPI print. And I'm like, 10-year was dropping. We've bounced back. We do have a potential double top in this.
Mm.
Okay. Does that mean it has? Oh, I messed that up. Oops. Does that mean it has to trigger? No, but the key area I'm watching is this 4.26 on a closing basis. On a closing basis, I'm keeping an eye, because then we could get a pullback in yields. Contrary to that, though, we have a few weeks ago, we closed above. At the end of October, we closed above, or a couple weeks ago, that's 62.5. So we still have a 4.5 magnet price based off the 87.5 harmonic, and where this is the November contract, so I'll have to roll pretty soon to it's rolling now to D's, but it's going to be the same area around that 4.5 magnet price where we topped out back in April and retested and topped out at the end of May. So I'm still watching for yields to continue to climb. The only thing that would make me put a pause on that, and I then start watching for a pullback to potentially 4%, was if we closed below that 4.26 on a yield basis.
Okay, and you said it was interesting today with the drop, right? With core CPI coming in a little hotter year over year, everything else being spot on. You would expect yields to reflect that jump in CPI, right? That unexpected, if you will, 0.2% difference. And maybe it's correcting now. There's big buyer's wick on that candle today.
Yeah, that's exactly true. So I got to stick with the probabilities and the trend. We're still holding the rotation zone. Trend is up, and the probabilities are still saying up. The only thing that would shift it is if we did trigger the double top. Remember, the double top started a bigger move in the euro that we covered at the beginning of this.
Right.
That's why I do watch them. A lot of them never trigger, but it gives me a very clear line in the sand of what to watch for in the short term.
And where would that close be? Let's say today it happens, tomorrow it happens, maybe next week it happens. But on this daily chart, we have the double top kind of evident right here. But how far above where we are now would you say, you know what? Double top, not really in effect. This is a clear close above that level. Is it that line of those two of that first big green candle of the double top, the
What?
top of it?
No, it's actually what I do, and this is the way it's been tested out. I put on my harmonic extensions,
Okay.
and then the key level, let me just show you right here. So if anybody wants to play with this, what technically, with all the testing we've done, what technically invalidates it is if I put on the reverse harmonics, which means because I'm going backwards in time. So I'm taking the low, which formed the base of the double top,
Hmm.
from the 8th. I'm projecting back in time to the high on the left side, which was from the 6th. If we follow through and even trade above 4.523, the double top is potentially off the table. The early warning sign is probably going to be invalidated is 4.497. So if you see that 4.497 is roughly in line with that 87.5 harmonic right at that 4.5 level. So that's still a very key magnet price, but the true invalidation would not happen until we get above 4.523.
And so you mentioned trade above. So if we wick above that 449, are we still looking at closes here?
No, this is all, if you trade above 449, it's still in place. But if you trade, even on a wick, you don't need the close. If you trade above even one tick above 4.523, it's off the table.
Awesome. Okay. That's a really great explanation. And again, that lining up, that confluence, the stickiness, or the clusters of that 87.5 and compared to that really tight extension, if you will, it's amazing how they just kind of arrive at the same levels. They're important levels.
Yeah, so that's the one. If you're looking at these micro yields on the 10-year, really pay attention to that 4.5 level in the short term.
Awesome. Mike, we've run up against time. It always goes by way too fast. But if people want to, follow your work and ask you questions, reach out to you, where can they do that?
YouTube, search for Path Trading Partners, the channel. I'm on there every day, pending no computer issues. And follow me on X at MG Arnold.
Well, Mike, I will say we are really happy that you figured out those issues today. I mean, it's not just you affected, but we're so happy that you were able to come on. And we'll do this again very shortly.
Yeah, I think we were scheduled for a couple more times, especially I think now I'm back the day before Thanksgiving. So, we'll see what the markets look like going into Thanksgiving Day.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.